Good morning, everyone. I'm waiting for our trustee assistant, Linda, to make it back. Glad to be back in person with you. Also, not to put Aileen on the spot as she comes in, but this is my first time getting a chance to welcome her in person. So welcome to the board here. We're excited about having you. Congratulations on your election. Okay, outside of that, as we wait for Linda, I'll at least have a chance to make part of the public record the agony of having lost to the University of Kentucky yesterday as a Duke fan. There might be and Chris have already had a chance to lament about losses of both of our teams yesterday in basketball. But thank you. So now we can begin with the more formal part of the meeting. And if you want to go ahead and read the well, actually, let's go ahead and start with the Pledge of Allegiance, if I could. Mr. Gatto, I know as much as it may be painful to stand up, if you could lead us in the Pledge of Allegiance.
Okay, everybody, please face the flag. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. All right. With that being said, can we get a roll call for attendance?
Ms. Ginsburg? Here. Ms. Nee? Here. Mr. Green?
Present.
Mr. Rue?
Here.
Ms. Martin? Mr. Gatto?
Here.
Mr. Fay?
Present.
Mr. Jones?
Present.
And Ms. Langton? Here. Okay.
All right, great. Next order of business is approval of minutes. Do we have any objections, comments, corrections, or anything to the current record from last meeting? There being none, may I have a motion to approve? The roll.
Mr. Green?
Aye.
Mr. Rue?
Yes.
Mr. Jones?
Aye.
Ms. Ginsburg? Aye. Ms. Nee?
Aye.
Mr. Gatto? Mr. Fay?
Aye.
And Ms. Langton? Aye. Okay, the motion passes unanimously.
All right, thank you. On to the next item, which would be our public comment. Did we have anyone who wants for public comment? Okay. No, with that being said, we'll move on to, I think, what is the primary entree of the meeting for today, which is a report. Oh, hold on, looking at the wrong agenda. The wrong one. There we go. Let's go into our executive update. I'm sorry. And you're still the entree, John, with the Chief Investment Officer's report. Thank you.
I'm hungry. Good morning, Mr. Chair, trustees. It's great to see everyone. First of all, it's great also to have to owl it and kind of look, across at a full, almost full day. So it's great to be here. We are in the home stretch of 2024. It's hard to believe that we're saying that. And I'll just start by building upon the equity committee meeting that we just had, and maybe the economic theme of calendar year 2024 is momentum in the public equity markets. So we're all going to summon kind of the inner factors looking backwards. There was discussion about do the models look backwards or forward. I guess we'll look backward about how prominent momentum and growth has been in the public equity markets calendar year to date. And that makes the discussion that we had very timely as it impacts the portfolio, and also even more timely given that we have a growth structure review scheduled for later this morning. And growth is our largest asset category, over 50% of our assets, and per our investment policy statement, the primary driver of long-term return. So I guess we'll summon momentum and keep that through line to our structure review. If we could turn to page 4, please. And so slide 4 shows the global market performance as of October 31st. I'll note Halloween and the performance are kind of lots of treats and very few tricks. When you look at the performance, starting with the global equity markets on the top left, you can see over the 1-year period, global equity markets are up 32.2%. over the last 12 months. That's just a phenomenal 12-month run. Once again, reflecting upon the equity committee discussion, alpha, beta, whatever, that's a pretty good beta to have, considering that our benchmark, our actuarial benchmark or threshold is 7%.
Right.
So, and then within that 32% over the last 12 months, there's significant outperformance within US large companies. On the top right, we can see the US aggregate bond index, and that has also performed very well over the last 12 months from a return perspective, up over 10.5%. And if you combine A plus B, A being global equity, B being US bonds, those strong performance in the equity markets with lower bond yields kind of creates lots of brilliant investors. And I think to me, and I spoke about this last month, I kind of go to my greatest hits album quite frequently, is that, typically is a sign for caution when everything is working. And putting that in LACERA parlance, it's cause for us to adhere to our core investment beliefs, that diversification protects us from multiple single points of failure. And that belief in diversification, in adhering to our investment beliefs is an imperative for us, a strategic imperative, given that we are cash flow negative. In the good of the order at the last meeting, there was a reminder to everyone to vote. And I was asked by several trustees to comment this morning about the election. I will steer away from politics. That's not my job. I'll be responsive and provide several comments from the perspective of capital markets while we're on slide 4. If we can pull that back up, that would be fantastic. And when you can see, or once again, maybe going back to our investment beliefs, that we do not know what will happen. That's the primary takeaway from any macro event. We do not know what will happen. And it's always premature to make a declarative event about events, about macro events. The one truism is that different asset categories may, and I'll emphasize may, react differently to events. So equities, for example, may react positively from lower taxes or less regulation. That's a may. And we've seen that over the last 5, 6, 7 trading days. There's a belief in that, but that's not a cycle. On the other hand, bonds, interest rates may go up because the belief that there will be larger deficits. And with that higher cost of capital reflected in higher interest rates, that will have significant implications across markets, and it will impact different asset categories differently. And the one wrinkle to that is that there will be global divergences in terms of what those reactions are. So within asset categories and across asset categories, things will change. The magnitude of those changes and amplitudes, we don't know, but we need to be prepared for everything. So I don't like to speculate, but we should be, and we are prepared for many things to happen. Maybe there will be less autocorrelation like we see on the slide that markets have been moving in tandem. Maybe they'll move less in tandem, and it's a maybe. Another definite maybe is maybe there'll be more volatility in the markets. So the gist of the election, from my perspective, is that our asset allocation is our best offense and our best defense at the same time. So that's my answer to the questions about the election, in that it's a big maybe, but we're positioned for the fact that more things can happen than will happen. So if we turn to slide 9. Slide 9 shows the results for the fund through September, the end of our first fiscal quarter. the fund was up in the month of September, 1.2% net. We cash equivalents at a comfortable 1.1 billion on, as you can see in the bottom middle table. And if you look on the bottom left, total market value, dollars and billions, it says 81.6 billion. There has been, and then the chart underneath that shows the last 12 months and what the total market value of the fund, the pension fund was, and there's a steady progression up. So if we look at October of 23, we're a little over $70 billion. We finished September at around $82 billion. That's fantastic. I mean, that's the type of thing we like to see. Can we expect that to happen? No. But when it does happen, it's something that that certainly does benefit all of us. It benefits our mission, benefits all of our members. On the right, we can see the asset allocation shown by functional asset category. Here, this reflects the changes that have been made based upon the board approved the new strategic asset allocation that took effect at the beginning of fiscal year 24. If we turn to the next slide. So here we show returns for the fund and OPEB and various functional categories over multiple time periods, and we compare it to benchmarks. I'll reflect a bit upon the equity committee meeting that we just had, and there was discussion about beta and alpha. The one thing that I caution all of us to think about is when we use the term alpha. Is alpha bad measurement? Is it kind of bad benchmarking? Or are there different benchmarks that are appropriate to measure different things? And there are, and we use a variety of different benchmarks. And we can see on the top under the total fund, where we have the total fund policy benchmark, and underneath that, the actuarial hurdle of 7%. Those are very different benchmarks, and they reflect different things. So I think it's always important for us to maybe ask the subsequent question when we discuss alpha: how do you attribute and how do you define that alpha? I think that's a really, really important thing for us to do. So if we can see in the top chart, and I'll go back to my notes, the pension, fiscal year to date, we're up 3.9%. We're slightly ahead of our benchmark. Is that alpha? I don't know. And I'll qualify it this way. We have had in the first quarter, it's a noisy quarter because we began to shift our asset allocation. So day one of the fiscal quarter of our fiscal year, July 1, the benchmarks moved immediately. Our assets don't move immediately. It takes time to make those changes. So there'll be what's called tracking error between the old portfolio and the new portfolio. Is it great to be ahead of benchmarks? Yes. But I would say that there's noise within the first quarter. Maybe another interpretation as it relates to is it alpha is we're solidly ahead of the actuarial target when we're, our pacing is 1.7% on a quarterly basis, and we're, more than 2 times that. That's not, those aren't results we expect, but that's fantastic. Also within the chart, you can see that there have been positive contributions from all functional categories. They performed very well over the quarter. And moving to the bottom, we can see the OPEB trust. The OPEB trust hit a high water mark during the month end of 4.4 billion. And maybe I'll pause to mention that in our materials in the investment industry, there are lots of acronyms. There's certain 3-letter acronyms that I use a lot, SAA for strategic asset allocation, IPS for investment policy statement, but my favorite's probably HWM, high watermark. So the high watermark, the HWM in September for the OPEB is fantastic. And I think it's something that we need to recognize how much the OPEB trust has grown over the last several years. It really has performed very nicely. So OPEB was up 1.9% for the month, 6.3% for the quarter, recognizing that the annual actuarial hurdle for the OPEB trust is 6%. So we hit 6% in the quarter. So we did the year and the quarter. The big driver for OPEB were public markets. Specifically, OPEB has high allocations to global equity and to REITs, which are listed real estate kind of investment vehicles. And that's really the difference between performance of OPEB and the pension. It's important to, once again, reflect upon diversification and our investment beliefs that the OPEB trust over the last 12 months was up 21.3%, which is, a phenomenal number. Yet over longer time periods, it still lags the pension, which is a much more diversified pool of investments. So turn to the next slide, please. And I'll draw everyone's attention to the chart on the bottom. And maybe this will talk a bit about alpha in the context of different yardsticks. So the chart on the bottom compares the actual performance of the fund to its custom and actuarial benchmarks, two different benchmarks, and that's over a 10-year period. In it, we compare in the chart, the actual performance compared to these benchmarks, and the performance or the differences are significant. And I'll highlight those significance in terms of dollars. So compared to the actuarial benchmark, the cumulative excess gains over that benchmark over the last decade is $21.8 billion. That's a wow. I guess it's another three-letter word, not an acronym, but that's just a big wow. And that's a form of alpha. The policy benchmark, which the board adopts as part of the strategic asset allocation based upon capital market expectations and then refined within structure reviews or used within structure reviews, the cumulative excess gain over the last decade compared to the board's policy benchmark, that excess gain is $8.1 billion over the last decade. So once again, those are big wows. And that pays a lot of benefit payments, and that reduces potentially lots of stress on the plan sponsor, on our members when it comes to determining how much in every pay cycle those contributions are. And it's a result of these different forms of alpha. I'll turn to slide 18. Here on this slide, there's a lot of information, but on the bottom right, we provide updates on various RFPs. I guess it's another acronym, but request for proposals. In this month's packet, there is a update on our risk and analytics RFP that was conducted. And it was said, once again, during the equity committee that all investors care about data. We too care about data, and how we use data really helps us be better investors and maybe better identify the difference between alpha and beta and better generate returns for the benefit of our members. The second RFP that's listed here is our Real Assets Emerging Manager separate account program. We're hoping to finalize that by the end of the calendar year. So that's next month. So I guess we have a lot of, we're kind of in the home stretch on that. So we hope to finalize that, and then shortly thereafter, we'll notify the board. And I'll finish on slide 20. We have a busy couple of months in front of us. Next month, we're preparing for the board our, I think it's third annual TIDE report, that update for the board. We also have a real estate structure review planned for next month, and a fee report, which is a requirement for all public plans in a public meeting to discuss fees paid. We go above the minimum you're required to talk about for alternative fees. We talk about fees across the portfolio. In January, we're developing our annual work plan and strategic initiative review that will be presented at the January meeting. And part of what will go into that is Makita, subsequent to last month's meeting. We've been working with Makita on a questionnaire that will be sent to all trustees about education, trustee education. And I believe the goal is to distribute that through SurveyMonkey later this week. And then based upon the feedback, that will be put into the work plan for next year in terms of how to be most responsive to trustees. And the other thing I'll highlight on this slide is team searches and vacancies on the right. We just posted a senior investment officer position in private equity. I encourage all people in the room, in the building, on the Zoom, listening, to apply for it. It's a great position, as are all the positions in the investment office. So with that, Mr. Chair, I'll pause for questions.
Thank you, John. Any questions, trustees? Go ahead, Jason. Trustee Green, I should say.
Thanks, John. Really cool. Just for my own education, the cash flow, that sharp downward turn, that was from monthly allocations, correct? The total value of slide 9, I think it is, with our cash, the 1.9. There's a steep decline. That's from asset allocations, correct? That's
Mr. Chair and Mr. Green, going into the month, the prior month, we knew that we were going to have lots of capital calls because we do a rolling 90-day cash forecast. So we finished the prior month with more cash in order to meet those cash flows early in the month. So it was planned. So there wasn't any specific spike or any excess buying or selling. It's that we always, monitor the portfolio for movements between asset categories. And when we make private investments, we don't know when precisely the flows are going to come, but when we're notified, we prepare and rebalance between asset categories.
And that's why we have that liquidity for
Yes.
that. Yeah, absolutely. That's awesome. And then the 3-year, I want to point this out. This is just, it reinstills, reinstills the wrong word. It reaffirms the confidence in the process, LACERA's process, your team's process as an entire company. And the 3-year on slide 10, that's encapsulating 2022, which was not a very good year. But then if you go back to slide 9 and you see the total market value, TMV, as you would probably say in the group, right? So, but it's this slow rising tide. It's working. Even the process is working. And I'm glad you talked about the macro impacts, and but it's like a sheriff or a firefighter. Something's going to happen. That's really the only guarantee, right? You're prepared for something will happen, right? And what you can't predict that, we carry a fire shelter for not when you get burned over, but if you get burned over. The sheriff carries a firearm not to when they get in a firefight, but if they get in a firefight. And so I think just for anybody listening, it reaffirms to me, how thorough and the process is, and it's working, and really thank you to your staff. I know Herman would be very pleased to know his retirement is secure. So anyway, that's it. I just, thanks for that,
Any other questions, comments for John at all? Thank you. Looking forward to the wrap of the year, that we end up even better on the reporting of all that as well. I think I had one, actually, if you go back to the end of the slide where we have the operational initiatives and everything on there.
Was it slide 18?
Yeah, I'm not sure if it's the second to last or the last one.
Or 20 maybe.
Yeah, so the people schedules and so that the annual fee report if I recall correctly, that was the one last year where we had the speaker that was, I think we had hired someone as an outside consultant to actually look at our fee structure. Is that, am I recalling the right meeting? I think it was a African-American gentleman that was just kind of giving us some feedback on some analysis that we had overall about our fee stuff. Is that the same type of thing to anticipate for this cycle, or is it something different that
I believe last year we did a trade cost analysis at some point,
I think that's what
which
it
was for our, it kind of dovetails off the discussion we just had about public equity. One of the ways we look to save is by being efficient with how we trade securities. This is a different report. We're required under the law. California passed in 2016 or so, AB 2833, I believe, was to, in a public meeting for plans on an annual basis, to disclose fees paid to alternative fund managers. That's what this fee report is. And we go above the requirement by the law and disclose all the fees, not just those alternative fees.
Got it. Okay, thank you. All right, thank you, John. Member spotlight. So,
Good morning, Chair
Good morning.
Jones and trustees. I'm Laura Guglielmo. I'm the Assistant Executive Officer overseeing the Business Services Group, and I'm subbing for JJ Popwich today, who's at Sackers. So this is the time in our meeting where we recognize and acknowledge the work of our members and their service to the citizens of Los Angeles County. It's our reminder of why the work we do is so important. The decisions we make impact real lives. And so today we're going to highlight our Fire Captain Garrett Chiaretti. Captain Chiaretti has served the Pomona Fire Department and LA County Fire Department for a total of 32 years. So in that time, I imagine he saved quite a few lives. In retirement, Captain Chiaretti is planning on traveling in Europe with his wife and completing home renovations and enjoying his many outdoor hobbies. He's most proud that his 3 sons will follow in his footsteps and have chosen careers with the fire service as well. And so today we thank and acknowledge Captain Chiaretti for his dedicated service to the public and wish him a long and healthy retirement.
yeah, compliments to Captain Chiaretti there. He must have started when he was 12. He looks like a young man. There's a photo there. Yeah, I'm just like, oh my goodness. But yeah, congratulations on that. Yeah, I'm just like, wow, look that good at that age after 32 years of anything. All right, so then the next part is our Chief Executive Officer's report. Santos, good to see you, man.
Yes, thank you, Chair Jones, trustees. Good morning. Very brief report from me this morning. Just wanted to confirm that the Board of Supervisors, their meeting on October 8th, ratified the election. And I'm glad to say that Trustee Eileen Langton had joined us last month at the Board of Investments, and we're looking forward to welcoming you at the Board of Retirement beginning in January. So I'm hopeful that you're happy and satisfied with the support that you've been receiving from the investment team, as well as the pension side, orienting you on the various programs that we're running. So
Extremely, thank you.
great, thank you, and welcome aboard. We do have our management offsite, which will be next Tuesday. We're really looking forward to that. I know that I've reviewed all of the materials. We're in the process of collating all of the presentations, and so we're focusing in on making sure that we're on task with all of the strategic objectives and goals that the Board of Retirement has placed on us, as well as the Board of Investments have agreed to in the approval of the strategic plan last fiscal year, I believe. So we're moving forward with that. We'll do a report out once we've had an opportunity to talk with all the managers and let you know. I do want to give Mr. Grable some thanks for participating in the offsite, the management offsite, as well as allowing his team to participate as well. I think the cross-pollination between the investment team and the pension side of the shop benefits greatly as a result of their insights. It's good to have another pair of eyes that understand what we do on our side, but have a different perspective as well. And so, so thank you, John, for that. Retiree healthcare, just wanted to make sure that you were informed that on November 26th, the Board of Supervisors will be considering the increase to the lifetime maximum benefit on our Anthem plans, which I think is a good first step. It's going to go from 1 million to 1.5 million. I did make a presentation before the Ops Cluster meeting. I'm sure you're very familiar with the Ops Cluster meeting. I did mention to them that it was a good start, but ultimately the trustees have directed me to completely eliminate. Our goal is to completely eliminate that particular cap, just from terms of fairness perspective, from active members' benefits versus retiree benefits. We think that that it really should be eliminated. So the plan is to evaluate migration patterns from one plan to the other. We have differing opinions about what that migration pattern is going to be. They believe it's going to be close to between 25 to 50%. Everyone that's in Kaiser is going to move over to Anthem Blue Cross, and that's just not going to happen. Our experience is we usually have between a 2 to 3% migration going in either direction. So it's a net gain on the Anthem side. With that, we're looking forward to evaluating on an annual basis. We'll be having the same discussions with the CEO's office sometime in August, September, just before we begin negotiating premiums for our retiree healthcare plans. So with that, that's the end of my report. I'm more than happy to stand for questions.
Any questions from my colleagues? Trustee Green.
Your confidence for November 26th, is it your confidence still high?
Yes, I have spoken to the board deputies. Now, I caution you, speaking to a board deputy and speaking to a supervisor are two different things. But the indication is that everybody seems to be supportive. All the offices seem to be supportive of the $500,000 increase. Right.
All right. Thank you,
Thank you.
Santos. All right. So if we get on to our non-consent item, the growth structure review. Christopher and team. All right. Welcome, Chris, Dale, Didier.
For today's presentation, I'll give some opening comments to set up what we're going to talk about, followed by a review of the growth functional category. And after that, Dale, who I refer to as Beta, will talk about the public equity portfolio. And Didier, to Dale's left, who I call Alpha, will talk about the private equity structure. Now, as a reminder, we've included a 2-page glossary in the back of this document. So if there's any questions about terms, hopefully the answers are there. So the investment policy statement defines the framework for managing the fund's assets. This governing document outlines the investment program's philosophy, structure, and key roles and responsibilities. As a longstanding belief in the investment policy statement is that the long-term strategic asset allocation is the primary determinant of risk-return outcomes. And as a result, the board conducts strategic asset allocation studies every 3 to 5 years to meet our investment objectives. After the strategic asset allocation study apportions capital across the various functional categories, Structure reviews like the one we're going to talk about today are conducted to address how to implement each of these asset categories identified in the strategic asset allocation. These reviews establish the framework for each asset category by addressing its role and expected risk profile, objectives, portfolio composition, related strategic initiatives, and how the portfolio may evolve in the near to medium term. So to assist the board and staff in carrying out their duties, structure reviews also include guidelines such as board-approved benchmarks, sub-asset category target allocation ranges, geographic market target allocation ranges, and any parameters and asset manager diversification relevant to the asset category. And finally, structure reviews are presented to the board for its approval no less frequently than the strategic asset allocation studies conducted for the total fund or at the board's request. So here on slide 3, we're going to talk about what is the role of growth, and you can see it there on the upper left with the purple circle around it. It's the category, as John mentioned earlier, that we expect to provide growth or the highest expected return, and it carries with it the highest expected return and risk. So per the investment policy statement, the growth category is the primary driver of long-term fund returns, while the growth category includes public equity, private equity, and non-core real estate. Today's presentation will focus only on global equity and private equity. Non-core real estate will be addressed in the real estate structure review, which you should hear about next month. So turning to the bottom left in global equity, the role of global equity is to provide broad global market exposure. This market exposure, or beta, or DALE, is obtained through a passively managed broad market index allocation. Global equity also utilizes active strategies where opportunities exist to outperform the market. It's the role of private equity, the lower right. The role of private equity is to maximize performance while balancing the risk of private investments. Typically, the types of exposures available in private equity are not the same as those available in the public markets. So the two combined offer good public-private diversification. Slide 4. Looking at slide 4 here. So if you direct your attention to the pie chart in the upper left, on the left side of the page, you can see that little over half of the trust assets as of August 31st were in the growth category. The pie chart on the right of the page shows how the 52% growth net asset value is diversified amongst global equity, private equity, and non-core real estate. Now going to the bottom of the chart from left to right, we show the components of the growth category. The current allocation to each subcategory as of August 31st, the board approved policy target under over percent, the target over under range, the target range, and finally the benchmarks. It's worth noting that all sub-asset categories in the growth category are within the board approved asset allocation ranges. Now, as the global equity and private equity portfolios are further built out, what are some of the implementation attributes you can expect to see over the next several years? Well, for private equity, which will be all the terms in the upper portion of the chart, you'll see partnerships where we can scale our commitments to drive co-investment opportunities and better fee and terms. We are also looking for strategic relationships where the interests of both LACERA and the manager's organization align. This can happen, we believe, through active LPAC or limited partner advisory committee participation. And of course, we want managers that can exceed the board approved benchmark. For global equity, we look at having broad market exposure across regions and market caps to lower portfolio risk. We expect to continue to use our equity ownership rights and proxy votes to safeguard LACERA's economic interests. And finally, we will continue to use separately managed accounts as necessary that tailor investment guidelines to LACERA's needs while still retaining beneficial share ownership and transparency with how the manager is building its portfolio. Slide 6. As a dynamic investment program, you can see here that on a regular basis, we adapt and respond to changing conditions. While structure reviews typically happen after strategic asset allocation studies, when a change is needed in the program's implementation, we will bring a revised structure review forward to the board for review. As an example, in 2020, after COVID hit, each asset category did a mid-cycle structure review to assess the effects of COVID on the markets. On an earlier chart, we identified the benchmarks for the global equity and private equity portfolios, the MSCI ACWI IMA for global equity and the MSCI ACWI IMI plus 200 basis points for private equity. Here on the left, you can see the sector exposures by industry that make up the MSCI ACWI index, as well as the growth portfolio's exposure to each industrial sector. You'll notice the one growth portfolio outlier exposure here is information technology, and that is due to private equity intentionally overweighting investments in information technology funds, which over the years, and we believe in the future will produce better than market returns. Transitioning to the bar chart in the upper right, you can see that the global equity portfolio exposures compared to the benchmarks exposures are pretty much identical, which is expected. While the private equity exposures in the bottom right chart have overweights in the areas private equity typically invests in, namely healthcare, industrials, and information technology. With global equity and private equity combined in the growth category, it is important to track separately each asset category's exposure to the various industrial sectors represented in the benchmark. This ensures that our implementation strategies are being followed as we intended. And finally, I'm happy to report that the growth portfolio has outperformed its benchmark in all time periods since the growth functional category inception in April 2019. It's been tough, as you've heard in previous CIO reports, as well as today, for the private market asset classes and growth to keep up with public markets performance over the past couple of years. However, the growth category's outperformance shows, as John said earlier, the benefit of diversification, one of LACERA's investment beliefs. That concludes my remarks, and I'll turn it over to Dale to take you through the global equity structure.
Thank you, Chris. Good morning, Chair and trustees. So on slide 10, we'll start with the overall global equity portfolio structure. As Chris mentioned earlier, at $27.5 billion, the global equity portfolio is 66% of the gross structure and 34% of the total fund. That's above its current target allocation of 30.5%, which will further be reduced on January 1st to 29%. This can be seen on the pie chart on the top left and the middle table there. On the bottom table, we break down the global equity portfolio into its sub-asset strategies, which is passive, the index fund, factor-based, which are low tracking error systematic strategies, active managers, which are fundamental, and quantitative managers or systematic, and then the emerging manager program, which is combined in the active group. On the next slide, we're showing the sub-asset exposures are within the board-approved guidelines. And here what we try to manage is both the regional exposure of the portfolio as well as the market cap exposure. So we list the exposure through LACERA's portfolio and then the benchmark in the table here, and the difference all the way to the right is a reflection of the underlying exposures to the asset managers and their underlying exposures to regions and market cap. So you can see we're pretty tight, just within plus or minus 2%, 2.6 on large cap, but these are within our guidelines, and we use the overlay to reduce these to less than 1%. Here we're just giving a brief market commentary over the last 2 years. It was mentioned in the growth equity presentation this morning. The growth committee presentation talked about the long-term performance of large cap stocks. So you can see on the top chart on the left, US stocks have outperformed non-US stocks over the past 9 years. So that's been a long run for US markets. On the bottom, you see large caps versus small caps. It hasn't been as long of a run, but large caps have outperformed over the last 5 years, as noted primarily by the large tech stocks. On the next slide, we're showing the performance of the global equity portfolio and its some sub-strategies. Again, the passive, the factor-based, and the active. We would like to highlight that all of these strategies are outperforming over their 3, 5, and since inception periods. While the inception period is relatively short of 5 years, this reflects this change in the portfolio to functional asset categories and a broad restructuring of the global equity portfolio. Again, I would like to highlight the information ratio, the Sharpe ratios, which are above their benchmarks and positive. And in the sense of the up capture, down capture, that's when markets are going up, our portfolio is capturing more than of the upside. When the markets are down, our portfolio is capturing less of the downside. Those have nice positive spreads of above 100 and below 100. So we were happy with the way that the portfolios performed at this point. And here we're showing performance attribution since the last structural review, which was about 2 years ago, where a lot of these changes have been more formalized in the global equity portfolio. The top chart shows the performance of each of the sub-asset strategies relative to the policy benchmark, which is the MSCI ACWI IMI, which is the total global equity benchmark. And while the strategies are different from the benchmark in those underlying sectors, we wanted to show that ultimately we expect the whole portfolio and its components to outperform the ACWI. So on the bottom chart, what we're showing is those sub-strategies, the passive, factor-based, against their respective benchmark, which in the case of the factor-based and the active, is the asset-weighted benchmarks that those managers manage against. So we're happy to see in all those instances, the managers are outperforming their benchmarks. And in the top chart, almost all of them are performing the ACWI, the policy benchmark. And here we're just showing what we call the attribution between selection and allocation effect. This is how we're allocating money to our investment managers. So we allocated to managers that outperformed, plus the managers that we over allocated money to that outperformed also delivered strong performance. So in total, over the last 2 years, we've annualized 54 basis points of outperformance by our allocation to managers and their stock selection and portfolio management. Here we show the manager lineup, and this is broken down by strategy. So in the passive, we just have the SSGA for the index fund, which is 60.5% of the portfolio. We have 2 factor strategies, one for US and one for non-US. They comprise about 22.5% of the portfolio. And then we have all our active strategies listed below that. Next to them is the benchmark against which their mandate is managed. And then we have the inception date, their market value exposure, their exposure in the global equity portfolio. We've also included their since inception returns and the quartile rankings of those managers within their peer group. So a couple of things I'd like to point out here is we have some very long-term mandates. We can see we have a mandate going back to 1987, which is, I'll get into their portfolio a little bit more later. And we have some new managers that as the portfolio is restructured over the last 5 years, there has been some turnover and some additions to the portfolio. And I think to the equity committee discussion, we have a mix of systematic and fundamental managers. Some of our fundamental managers are very long-term, like Frontier Capital. And this is our manager, what I call manager map chart. And so what I'm trying to do is plot where our managers fit relative to our policy benchmark, the MSCI ACWI IMI net. So on the bottom, we show the regional breakdowns. We have global, which means they invest in every market. Then we have US equity, which is the biggest component of the ACWI index, then non-US developed markets, and then emerging markets. On the vertical axis, we show large cap, middle cap, and small cap stocks. Large cap is about 80%, mid cap is about 10, and small cap is about 10. So what we're showing here is our index fund and our 2 emerging manager programs are all cap across the globe. And as we move to the US equity section, we have JP Morgan, which is focused, it's a factor strategy that's focused just on large and mid cap stocks. And then we have Frontier and Systematic on mid cap and small cap stocks to kind of get that total market cap exposure in the US. In the non-US, we have 3 broad mandates, the Acadian Capital Group and JP Morgan. JP Morgan is the factor strategy. Acadian Capital manage across all developed markets ex-US, and they manage large and mid-cap stocks. JP Morgan, again, is the factor strategy. They're mostly focused on the large cap space. So what we're missing there is the small cap, and that's what Global Alpha. They invest in small cap stocks across non-US developed markets. And finally, we move to emerging markets. We have one manager there, Lazard. So that's our manager map and how they all fit into the global equity portfolio. Here we're showing the risk summary for the growth asset class in the top left chart. You can see the total for the growth asset class, and then global equity is highlighted there. So it's 66% of the global of the growth category. The total risk for the global equity portfolio is lower than that for the total growth category. And its contribution is lower because it's a diversifier. And so even though it's 66% of the weight in the growth category, it's only contributing 61% to total risk for the growth category. On the bottom chart, we break down the global equity portfolio into the basically three categories: the active, factor-based, and emerging manager program, which is part of active, separated here, and passive. And you can see the distribution and risk, which is basically the forecasted volatility of that strategy, and then their contribution to total risk of global equity. Finally, just a quick update on the emerging manager program. As a reminder, those were funded late in second quarter, so we just wanted to give a snapshot here. We hope to provide more fulsome updates in the future once we have a longer track record of the program. And finally, we move to the recommended changes. So given all the background of the previous slides, what we're recommending here is, if you're looking at the current structure, we have the passive, factor-based, and active sub-strategies. What we're recommending is moving to a passive and non-passive. So the passive would stay the same, and we combine the active and the factor-based into the non-passive strategy. This is really just only an administrative change for us. It isn't going to change how we manage the portfolio. It's not going to change the underlying structure. It's not going to impact any of the managers. As we've learned from the rebalancing with the most recent strategic asset allocation, these constraints on the factor and the active, plus their sub-exposures, has kind of made us had to contort a little bit in how we reallocate assets when we're liquidating to fund some of the other parts of the program. Plus, when you're looking at the benchmarks and you're benchmarking each sub-strategy, the benchmarks aren't exactly clear because it's a blended weight of the underlying strategies. We're here within the non-passive, everything combined is against the policy benchmark. So it's going to be clear to see where the performance is coming from. And with that, we have the proposed investment guidelines, which summarize that change. So on the sub-asset class structure, we move from passive, factor-based, and active to passive and non-passive, combining the factor and active. We're also changing the description of the manager diversification. So no single manager shall exceed 10% of the global equity portfolio, excluding the managers with less than 1% tracking error. So that would be the index fund and both factor strategies, which is noted in the earlier slides. The index fund is 60% of the portfolio, and the factor strategies are combined 22.5%. So JP Morgan would be violating that if we didn't exclude them. But these are large investment firms, long established, good track records. So what we're applying this to is the active strategies. Anybody with a higher than 1% tracking error would be capped at 10% of the assets in the global equity portfolio. Another change that we're making is the tracking error. Instead of a range from 1 to 2.5% over a 7-year period, we're just saying up to 2% over a 7-year period. For reference, our historical tracking error over the last 5 years has been 0.8%. So we've actually been under that old guideline. So that concludes our
Dale, quick question for you. The
Yes.
shall not exceed 10% is that just a best practices metric? Is that something calculated based on our own kind of allocation? I'm just curious.
Yeah, I think it's to be consistent with what we had before, but we just wanted to clarify who it applied to.
Okay.
I think as we get into the active space, then we don't want to become too much of that manager's assets. So I think that's part of the measure there to manage that exposure.
Quick question for me. For slide 20, just doing math from the left to the right, we've got if you add those two together, it'd be 20 to 60% for the non-passive. If you took factor and active and combine and add them together, and now we're going from 30 to 50. Is there a reason why we wouldn't want to just use the exact same things and just add those things up? And that we want to have a tighter band?
I think we were comfortable working in the band that we have. So the passive strategy, we expect to always be around 60%, but we don't anticipate going to 80%.
So I remember the non-passive strategy. So we have the target's still 40, but if you looked at factor-based and active and you added them up, those two ranges together, it'd be 20 to 60. And then when it comes to on the right, the proposed structure is 30 to 50. So is there a reason that you want to have less flexibility with that?
I think we're trying to manage the potential tracking area that could come in the portfolio by really shifting those exposures. If we expect the factor strategies to be 20%, and then we don't have any active. So I think we would be concerned about eliminating part of our exposure to either factor or active strategies, so that we have balance.
Yeah, Trustee Me.
So go back to slide 13. So this is like, I have a question. I like both investment team and consultant to comment on this. So I'd like to understand better, what active investment, the role in this portfolio structure is. So when we put together a portfolio, every asset class have their function, right? So in like a football team. So this one, I have a little bit difficulty understanding because like active investment, as you can see in the benchmark, is lower than the other two, passive and factor-based. Lower benchmark, that means a lower expectation return. However, the risk is higher, right, compared with the other two. So why do we invest in something that high risk, low return? And I'm sure there's a job that this asset class does, and what the role is.
Right, so our primary role is to provide beta, and where there is opportunity as a secondary consideration to provide alpha. So the way we get the beta is through the passive portion of the portfolio and to some degree the factor strategies. Where we're trying to take advantage of the active exposure is, if I can go back to my map here, if I'm going the right way. Yes. So if I look at this chart, basically what I'm saying, everything going from left to right goes from efficient to inefficient. Everything going top down is going from efficient to inefficient. So where we want to, if we have comfort that those areas remain inefficient, we want to be in emerging markets, non-US, because those are less efficient. So we think we can generate extra return or alpha from those areas of the market. And in the US, we go to small cap because we believe that is still to some degree inefficient. So we're willing to take risks there if we think we can get rewarded for that risk that we take with extra alpha, with extra returns, excess returns.
So basically we're positioning to invest in the sector, this emerging market and smaller caps, less efficiency. So we don't want to miss out on that segment of the market. So
we have beta exposure to those markets, but we think they're inefficient so that we can extract more alpha out of those areas.
Yeah, the performance doesn't seem to be ideal. So does consultant have any comment on this question?
I mean, I think Dale nailed it, but maybe can you go back to that other chart that had the manager roster?
Might go the wrong way. Yeah. This one?
No, with the roster. Yeah, so overall, the idea of having the active exposure in small caps is that market efficiency and also in emerging. So essentially, we just did an update of our study of where managers are able to contribute alpha and beat the benchmark. In small cap US, 70% of managers over a 5-year time period are able to beat that benchmark. So it shows that you have not a guarantee of capturing alpha, but a high probability through a manager selection process of selecting a manager that's able to generate alpha. So that's why that's there. It does show up as an additional beta exposure, which is why the benchmarks are different. The benchmark for both the factor and the active is essentially a composite of the underlying managers that rolls up. So that's why you see the different benchmark performance. And as we heard this morning, and John pointed out in the CIO report, large cap stocks, particularly US large cap stocks, have massively outperformed small cap stocks over that 10-year period that they highlighted in their presentation this morning. So that's the reason so the benchmark performance is quite different, but that's the underlying factor driving the benchmark performance.
Got it. Thank you. So drawing back to the educational section earlier this morning from Elaine, the active managers, typically the industry practice is that they're compensated by performance, right? So the fee structure, is that what we have in LACERA, active managers? Performance-based
We do not have
compensation?
performance-based fees.
So it does not align with the typical industry
That's
practice?
actually not industry practice to have performance-based fees in global equity mandates.
Yeah, it's very unusual to have performance-based fees for long-only mandates. Typically where you see that is in hedge fund strategies, certainly in private equity strategies. And then there are some systematic quantitative strategies that are hedge fund-like, I would say, that utilize it, but plain vanilla long-only equities is an asset-based fee pretty much exclusively in the industry. I think there's, certainly you do get better alignment with performance-based fees, and that's something that could be contemplated in future iterations of the program. But the market standard is not to have performance-based fees on long-only products.
Got it. Maybe you misunderstood what Elaine's explained. Thank you. Next question is go to slide 13. Actually 20, I'm sorry. So it's the same slides that everybody else asked question earlier. Slide 20.
Oh.
If you don't mind. So I'm looking at this proposed change in the guideline here, right? I've thought about it. Our LACERA practice procedure today is that we have delegate authority to the team, and then all the board does is that we approve policy, approve structure review like this. So when I see this combining it, I have this tiny little bit concern that do we remove some guardrail there? And I know the flexibility bring value as well. So does it mean that with combining, potentially we could just invest totally 100% or 40% to factor base, or the other way, like 40% totally on active? So that would potentially bring in like the opposite of what we believe in investment belief, like the diversification. So I have that concern there, and I would like to hear the thought there from both investment team and consultant as well.
Yeah, the intention wouldn't be to exclude any strategy. And I think that's why we have the narrower bands there. I think it's really just an administrative change that we're making to manage the underlying profile of the managers. I think if there was that much of a strategy shift, it would still be within our purview to bring that before the board. If we're changing our approach into how we're managing the portfolio underneath, I think that would be another item for a structure review.
And maybe if I can just weigh in, when we reviewed it, we looked at that sort of as a trade-off. So on one hand, you are removing the narrow constraints for the factor-based and the active, but you are tightening the range on the other hand for the sort of total category non-passive than where the combined would be, just as we were discussing a minute ago. But also philosophically, when I look at the categories here, and I think we learned some of this in the presentation this morning, there's a lot of gray area and overlap. So passive is like crystal clear what it is, right? That's beta exposure. It's super low cost. It's nothing else, right? And everything that's in this non-passive category now, we heard that some active return is derived from factor exposures. There's just a lot that's combined there. So from me, thinking about it at a high level and what the truth is of how returns are generated, having it as a non-passive, or maybe you call it return alpha seeking or whatever, but non-passive is a spectrum of things. And I think it's better captured and expressed this way than previously. I think it was overly constrained in the prior iteration.
So before John responds specifically to that question, is your question on that
Yeah.
or something different?
So thank you. So I have the same question. I thought that was actually a very good question. My concern would be just in respect to the board doing its duty along the same lines of what Trustee Mee said, which is, this seems like we are giving such a broad guidance with that category that I'm a little concerned that we're sort of absolving or not following our duty. Wouldn't the question be, or wouldn't the strategy be to maybe perhaps better define the subcategories? I realize there's a lot of overlap. I realize there's a lot of different things that could qualify as either, but wouldn't the answer be to define those better so that we can give more precise guidance than to just give this amorphous? Because if guidance is so amorphous, it's not guidance, right? If the board approves different bans that are so broad, then we're not really doing our duty. So I have the same question.
Maybe I could just weigh in. I think you'd end up in the same place because you'd have to make each one of the subcomponent definitions so broad to be able to include the flexibility of overlap of like, can factors play a role in the sort of active only sleeve? And we know that that's true, right? Like mathematically, when you're trying to select cheap stocks, you're automatically selecting a value factor as part of your active process, right? So you're going to have to define those categories in such a nebulous way that you're right back at the same place. And then the other thing that I would point out is the standard industry practice is actually this way, just calling it active and passive and then letting everything live in active. I think, the LACERA approach is much more nuanced than what we see across the industry overall right now.
Go ahead, John. Yeah. So it's primarily an administrative. I get the question you're asking, but it's just an administrative thing to make it simpler. Nothing that they're delegated the authority for to make decisions are based on that has changed. It's just like the administrative component of it. John, did you want to?
Mr. Chair, if possible, can we go to the proposed guidelines page? Yes. In some sense, rather than thinking about the portfolio as a portfolio of managers, if we parse through all of that and look at, we have stocks, we own lots of equities, and the primary governor that the board has is that bottom proposed guideline, which actually, I believe, tightens the program a bit and there's less authority or less freedoms. It reduces potential volatility or tracking error from 2.5% to 2%. So the program as a whole, as these guidelines in terms of what's proposed, is actually less ability to move away from the benchmark.
Does that make sense? Does anyone else have a question? Wanted to follow Jay Money, or did you have?
Yeah, I mean, there's a tighter constraint on the active risk that staff can take.
Jason.
I'm just looking at slide 16 with the market value, allocations. You got, first off, I had a quick question. The inception date, is that inception date of the fund, or is that when we joined them?
It's when we invested with the manager.
Thanks for that clarification. But looking at the alpha in that second to last column, and then, I guess just addressing the nomenclature, the consolidation between passive and active, though it's 22.5% of the whole, global equity, we have one managing group, more JP Morgan US and JP Morgan non-US. And then we have this really kaleidoscope of diversification in there. And I don't know, maybe I'm wrong, but I think it's just a nomenclature thing. If that eases anybody's mind, it doesn't seem like it's going to be too complex. And like Tim's point, it's nuanced for us to have, this kind of separation. That's what I'm looking at. That's why, I think that renaming it is just that. There's a lot in a name, but I don't think it's going to limit, if that makes sense.
Trustee Fay.
I'm agreeing with that. And I'm also thinking maybe, and you guys can tell me what you think, if the reporting was done that had more of a, hey, look, this, when doing reporting, hey, look, we break down the non-passive into this one is more factor-based, this one, the other one based, we could see that we're still trying to diversify, right? You guys aren't trying to change anything, from what I understand, right? This is because it's just administrative. So for the fear that we're giving away the shop, even though it's unlikely because we're trying to get the best returns no matter what it is, we could just show what that is, and that wouldn't be that difficult because it'd be the same managers.
And you're going to get that every quarter in the performance book.
So that's a way of getting around it as well.
Yeah, and in future evolution of the portfolio, let's say, there are some systematic active that are in there. Maybe things get broken out even more granularly, fundamental, active, systematic, active, all of that can be in enhanced reporting. And that's definitely one of the things that, when delegation of authority was contemplated, enhancing some of the reporting and the analysis is a big part of that. So if that's something where people want more granularity, I think that can be accommodated.
Thank you. That does ease my mind.
John, you still have a look on your face, like you have.
Yeah, I mean, I appreciate that.
I
It makes
I'm sorry.
sense. Yeah, I used to call me John.
That's right.
John, apparently we look alike.
Yeah.
But
Very good luck.
Yeah.
thank you. Likewise. I appreciate that. I think it does a little bit to ease my concern. I'm still going to reserve my vote on this just because I still have some questions that I don't feel totally comfortable with. Hopefully no one's offended. Dissent is often a good thing. I just think, and maybe it's a lawyer in me, that we could do a little bit better in making these guidelines and definitions better. And if the answer is, well, we wait and see, and then we use those definitions, yeah, that's okay. But I prefer that we did it now. That's it.
Different voice is always great on a board. That means that we have this open, discussion and different opinion. We all come in different perspectives, so that we're not good thing. So, thanks.
Okay. Any other questions? Yeah, no, I just want to make sure that I think dissenting opinions are important when there's a dispute about the facts. I think what they were trying to do is just give us a common set of facts about what it is. And so I think there is some importance of making sure that everyone has an understanding of what it is, and that if your dissent is really a function of I still don't understand, then let's try and get to the deeper understanding rather than the implied dissent means I think there's something wrong with it. Something wrong is different than I don't understand it exactly. So I just wanted to make sure we provided that clarity in the public record. So were there any other questions? Okay. Can I get a motion? I'm sorry, go ahead. There's more to it, right? I'm sorry. Whoa, we forgot beta, or I should say alpha. DDA, sorry about that.
Thanks. If we could turn to slide 23, we'll start a discussion on private equity and its structure. The private equity structure is laid out in the table at the top. There's currently 4 board-approved sub-asset classes, which comprise buyout primaries, venture capital and growth equity primaries, our in-house co-investment in secondaries, and lastly, separately managed accounts. The 4 of these sub-assets combined account for $13 billion in market value, or about 16% of the fund. The trustees have asked us to go over some of the investment vehicles that we use to implement private equity. So I ask that we turn to slide 46, and that's 46 of the PowerPoint presentation. And thank you, Melissa, for driving. And so we go left to right and top to bottom. There's a lot of boxes, but we'll take it one step at a time. There's primaries, co-investments, and GP-led secondaries. Primaries are synonymous with fund investments. Our fund investments comprise 74% or closely to $10 billion of our private equity portfolio. Basically what happens is limited partners like LACERA, that green box, partner with private equity managers, otherwise known as general partners, in a fund. In this case, the fund is called a primary, and the primary invests in a diversified portfolio of companies, which we have creatively labeled as Company A, Company B, and Company C. when we look at implementation, we think about the trade-offs between primaries, co-investments, and secondaries. And one of the considerations for co-investments, which is that middle section, is how intentional can we be with our allocation to an industry, to a geography, to a business model, to our underlying company. And then the second consideration is that co-investments are offered on a fee-free basis. So while that parallel structure still exists to invest in the fund, which is the gray side, we do have the opportunity to invest in a vehicle that will then invest directly in a company alongside the private equity manager. And that's why you see Company C has a big green box that overlaps two structures. This is an important practice for us, and it's also a really interesting part of the industry, as there's a lot of demand for co-invest because of the ability to generate excess returns. On the right-hand side, we have secondaries, and secondaries is a broad nomenclature for selling something that already exists. And they can be initiated by the general partner or the private equity manager, or they can be initiated by limited partners like ourselves. And just for reference, we did a large secondary sale earlier this year where we sold off our fund interest to the markets. In this case specifically, the general partner owns the private equity, or has invested rather, in the private equity company, and is seeking to sell the company out of its portfolio into another portfolio that it's basically to another fund that it's raising. So it may seem a little confusing because the private equity manager is on both sides of the trade. But the lead investor and other investors that go into the secondary fund are responsible for doing deep due diligence to understand the asset, to understand the fair value of the asset, and to understand the alignment of interest that occurs, because those general partners will also be investing in the secondary fund. You may ask yourself, why do we look at secondaries that are GP-led versus co-investments? And the answer is there's more time for those assets to have developed. Portfolio company C ideally has been invested for 3 years, is working great, is firing on all cylinders. The value creation plan is exactly on point. And rather than selling that to the open market to another private equity buyer, to a strategic, or to the IPO markets, the private equity manager thinks it can take a second bite of the apple and then provides us the opportunity to also participate alongside them. These vehicles generally come with lower fees than primaries, both management fee and carried interest. So these are the three main structures that staff looks at when evaluating the implementation of private equity. We can go back to slide 23.
Well, hold on real quick before you leave. Were there any questions on that structure? Okay.
Just a quick comment. I really appreciate this. Thank you so much. And we talked about education in last meeting, and this is what education at the fundamental that we're looking for, helping the new trustee understand how we do our job, in investment. So thank you.
Okay. Thank you, Dean.
So back on slide 23, we'll talk through each one of these categories in a little bit more detail. So buyout is the deepest market out there with the most number of funds, the largest number of funds, and it allows us to scale our investments. As Chris mentioned at the beginning of our presentation, the desirable attributes is for us to be able to be efficient with the deployment of capital. And we want to be deploying larger amounts of capital with general partners who can absorb the capital and deploy it prudently. Buyout happens to be the largest category. Then we go on to venture capital and growth equity, which tend to be investments in smaller companies that are growing much more rapidly. Those companies don't scale as quickly, don't scale as well as buyout. So our commitments to venture capital funds are a fraction of the size of our commitments to buyout funds. And we also have to be very prudent about the risk return trade-off, because not all venture capital funds are outperformers, and the performance starts to kind of overlap. Our internally managed co-investments allow for, as I mentioned before, a intentionality to the portfolio, but also reduce what's called a J curve, or a fee drag. And then lastly, as we continue to scale up our investments, we use separately managed accounts to access harder to access opportunities in smaller emerging markets. So think about Hamilton Lane managing on our behalf a fund of funds that invest in smaller and emerging funds and smaller ticket sizes. The next slide covers private equity's performance. And as Chris mentioned, and as folks have mentioned today, the public markets have far outperformed the private markets, and that's part of the reason for our one-year underperformance. If we take a look at the 5-year and the since inception numbers, however, the private equity program has outperformed by over 200 basis points annualized. and over 400 basis points annualized, indicating that over the medium and long term, the private equity program is working. The next slide covers our geographical exposure. And here we see all of our private equity investments across the globe, and they're concentrated in three main areas: North America, Europe, and Asia. And it's worth mentioning that North America has the deepest capital markets, which are most conducive to private equity. The next slide discusses an important aspect of what we have to do in terms of forecasting and deploying capital on an annual basis. The right-hand chart has a lot of moving parts to it, but we'll go through it slowly. The blue bars represent our private equity NAV. So if we look at 2024, we mentioned that our market value is $13 billion. And then we look at the circles at the bottom of the blue bars, and that's the percent of the market value relative to the total fund. So today, private equity is 16% of the total fund. The green line represents net cash flows. And all that means is money that's coming from our private equity managers to us, minus the money that private equity managers are calling down to make new investments. When we're negative from a cash flow perspective, our NAV increases because our managers are making more investments than selling. And when we're positive, it's the opposite. So we really want to be careful with the green line to help us with the purple line, which is how much do we commit on an annual basis. Historically, over this time period, we've committed somewhere between $2 to $2.5 billion. And based on sort of our forecasting and our work through the portfolio, we expect that pacing to remain about the same. There are two key points on the left-hand chart that I really want to discuss, which is one, in 2021, the board approved increasing the allocation of private equity from 10% to 17%. And that's our target that we want to maintain going forward. And then in number two, in 2022, the board approved changing LACERA's annual commitment amount from a discrete dollar figure, AKA like $2 billion, to a percentage of the total fund, so 4 to 5%. And that's how we plan on deploying the rest of the fund.
Yeah, trustee.
A question on that. So when I'm looking at these historical numbers here, so if I'm understanding this correctly, that the board changed the allocation in 2021, went from 10 to 17. Before 2021, though, I see some numbers where it was higher than 10, and I'm assuming that's just because market conditions drove down the value of other allocations. Is that right? Just these were relatively steady, but then let's say the stock markets went down, and then that's the reason why for the discrepancy.
Yes, a large part of that is the movement in public markets relative to private markets. Another big portion, and it's worth mentioning that the target's not a hard target, there's a range. And so we were always within range. But the second portion is our internal co-investment in secondaries program ramped in 2019 through 2022. And as we make those investments, the impact to NAV is faster than what we would do if we deployed the funds.
I see. Because this market is way, it's less liquid, and so the mark or the value of these businesses, right, or these funds is also less easy to define compared to public markets, right?
Yes.
Got it. Okay.
One other question. In the case that the entire market, or let's say that particularly the equity markets were to go down, then the purple lines would also be going down if we're trying to stay within a certain band, correct? So we're forecasting that everything goes up, but that number might change even if we have extra repatriations from capital in our current funds. So it doesn't actually change anything, but it's just something I want to say for everybody here to think through and think about, because that changes by us having it based on percentages.
Yes, Trustee Fay. So we revisit this exercise annually, and then if there's any large market movements. So the last time that we discussed this with the board was in 2022, but internally we discussed it in 2023 and 2024 twice, just to make sure that we're not over allocating or under allocating in any given year.
Yeah, and just to elaborate on what Didier just said, there's a lot of assumptions that go into these models, right? You have to model expectations for the total fund return. You have to model all of the different expected capital calls and distributions, right? So when the economy slows a little bit, some of those distributions may slow down. So it is prudent and best practice to review it annually, which they do. And then just highlighting some of these years where things jump around. I mean, 2022 is probably the sharpest one. That was basically everything in public markets was down, right? Public fixed income was down in the high teens. Equity markets were down in the 20s. So you just had a massive denominator effect, and private market valuations don't change. So you're never going to be able to be precise just because not just how many variables are in there, but how sizable those movements can be when you have a down 20 overall portfolio performance. And LACERA's portfolio was much more resilient than lots of the rest of the market. I was just giving you passive index returns. I think LACERA's portfolio was down like 11 that year, something like 10, somewhere around there. So much less volatile than the overall market, but a lot of that is because that private equity didn't change valuations during that period. So yeah, you are going to see fluctuations, and that's one of the fundamental reasons why we put ranges around these asset classes and allow for more degrees of freedom in the private markets, because you can't control those things because of the lack of liquidity.
Valuations.
Yeah, my thing is whenever I see numbers that and forecasts that go up and to the right consistently, is I'm like, well, hold up, that's not going to happen. We know that's not going to happen.
Go ahead. Yes, John.
And I think just building on that is why the board moved from a dollar basis of commitments to a percentage basis, because a dollar basis ignores the denominator and the actual position of the fund. By moving to a percentage, it forces us to be cognizant of how the total fund is performing.
Yeah. Actually, the only other thing that comes to mind, would that mean that if we had, let's say, a large distribution from a fund, or let's say a sell-off of a fund, we got a capital returned, and at that point, also the equity markets had done poorly, so now we have a much higher allocation to private equity, and we have more cash, would that then mean that we should be rebalancing and spending more or putting more into public equities because we want to keep the portfolio more balanced?
The idea is to maintain our target weight.
Yeah.
So the
do something
commitment
else.
amounts will be based on trying to maintain the 17%. There's a plus and minus 6% range to give plenty of cushion, so we don't have to necessarily do anything dire if there are movements in the market.
That last part was
And
important.
John may want to weigh in on this one, but the mechanics of it in the short run, the cash is equitized through the overlay program. So if you were to get an abnormally large distribution, let's say from like a massive public exit of something that was different than your plans, it would get equitized according to the asset allocation using the overlay. And then longer term, you would look at rebalancing opportunities on a more permanent basis.
Perfect. Thank you.
So thank you, Tim.
So continuing our discussion, we'll turn to slide 27, which focuses on our funded performance. As I mentioned before, it's about $10 billion in NAV, which is 74% of the private equity program. We see here that over the 5 and 10 year period, LACERA has outperformed its benchmark, but has missed the benchmark over the 1 and 3 year period. It's worth noting that the buyout portfolio has outperformed on a 3 year period, but our venture capital and growth equity has underperformed on a 1 and 3 year period, mainly due to changes in interest rates, which had a severe impact on valuations. We're careful when we think about risk return trade-off between buyout and venture capital and growth equity. That's why VC is a smaller portion of the portfolio relative to buyout. And it really should be thought of sort of as a selective growth engine within sort of the growth portfolio as the riskiest part of the category. Turning to the next slide, we show our in-house co-investments and secondaries performance. So as a reminder, we launched a program in 2019 internally, and we've deployed almost $2 billion in capital, $900 million to co-investments, which have generated an 18% net IRR and a 1.4x net MOI multiple on invested capital, and nearly $800 million to secondaries with similar performance, a net IRR of 16% and a multiple of invested capital of 1.3x. But a great way to see if the program is working or not is to compare it to our funds on a year-by-year basis. And so of the 5 years that we list out here since inception, the co-investments and secondaries program has outperformed 4 out of the 5 years. And in that 1 year, the performance has been almost the same. And again, this is attributable to being very intentional about the portfolio and security selection, but also fee savings. And if you want to get a sense of the fee savings, the next slide helps us quantify and graph sort of fee savings over time. So the left-hand chart shows cumulative fee savings, assuming a 2 and 20 model. And then the right-hand side puts it into context. So over the life of the program, it's estimated that we've saved $95 million in fees. And that equates to about, the monthly benefit payments of 19,000 members. And it's important to put that into context because everything that we do is for our members and to fulfill the promise to pay their benefits. If we could turn to the next slide, please. Here we have our separately managed accounts. We have 4 managers that currently handle separately managed accounts on our behalf: Pathway, Morgan Stanley, Hamilton Lane, and JP Morgan. And of those 4, 2 of them comprise our emerging manager program. That's JP Morgan and Hamilton Lane, which are 49% of the portfolio. The quilt chart on the right-hand side shows the relative performance of each one of these managers, the aggregate of our emerging manager program, and the aggregate of our total separate accounts relative to the benchmark. The benchmark is in gray, and similar to our program, the MSCI ACWI has outperformed all of the separate accounts. But on a 5 and 10-year basis, similar to our main program, all programs have outperformed the benchmark. We could turn to the next slide. I'll parallel some of the comments that Dale made. Within growth, private equity is the second riskiest asset category by volatility. And this makes sense because these are typically smaller investments that are highly levered. And on the bottom chart on the right-hand side, private equity's contribution to risk is greater than its allocation. So the light blue bar represents contribution to risk. The dark blue bar represents our allocation in dollar terms, meaning that private equity is riskier than global equity. If we turn to the next slide, please. Here we cover some current activities and some proposed guideline updates. So our current activities include scaling our allocations to strategic partnerships that can yield better terms, more meaningful co-investment opportunities, and enhanced governance through LPAC participation. We also want to continue elevating our investment due diligence to incorporate corporate stewardship and human capital practices alongside operational considerations so that we can continue delivering better risk-adjusted returns. And lastly, we want to be able to look through the portfolio and better risk manage the portfolio. The right-hand side has some proposed guideline updates, and we have the visual down below to show the same exact portfolio that we have today, just with some of the revisions in how we look at the portfolio. So the left-hand chart has 4 board-approved sub-asset classes today. It has buyout and venture capital and growth, separately managed accounts and co-investments. So some of those are 100% of the portfolio. And what we're proposing is separating the strategy into sub-asset classes, which is buyout and venture capital, away from the vehicle from which we receive that exposure. And so an analogy to think about this is like when you go to Chipotle and you get to pick your proteins, you get to pick how you get your proteins delivered to you. You can get a burrito, a bowl, or a taco. But at the end, you are getting the same protein you chose. In our case, the proteins are buyout or venture capital. So the sum of those two is 100% of the portfolio. And the way we receive that exposure is through funds called primaries, co-investments and secondaries, and separately managed accounts, and those sum up to 100%. Now you see the ranges change a little bit because we've taken buyout exposure that was hidden in separately managed accounts and co-investments and put them in the proper category. So we now know that we have more chicken in our burrito.
Oh, can't dispute that. Yeah.
Yeah. Or the bowl. And so with that, I'll turn to the next page, which has the proposed guideline updates. The first one is a tweak to our total annual budget, and it goes to Trustee's phase comments. We want to remove the lower bound of 4% to allow us to commit up to 5% in any given year if markets were to sell off and there was no exit activity. We don't want to be beholden to commit $3.5 billion to then increase our NAV that's already increasing because of the denominator effect. We want to be able to be prudent and deploy the right amount of capital relative to our cash flows. The second change is really renaming the sub-asset class into two categories: buyout, which includes several subcategories within buyout, and then venture capital and growth, which includes other subcategories within those assets. And we want the flexibility based on just how the allocations look today to have up to 100% of the portfolio be buyout and up to 30% of the portfolio be venture capital growth equity. And really the trade-off here is dependent on returns. As we saw, the 1 year and 3 year numbers within venture capital being underweight into this environment was a positive. But when that changes, we want to be able to find the right opportunities. And then lastly, we want to define the investment vehicle. We want to make sure we can deploy to primaries, co-investments, and separately managed accounts. And we're asking that the board consider increasing the amount to separately managed accounts to 20% from 15% to focus on those harder to reach opportunities that may be out there. If we turn to the next slide, please. These guideline updates are specific to the Emerging Manager Program, and they have to do with the renaming of the sub-asset class. So if we take a look at the existing guidelines that say mirrors LACERA's PE program, we'd like to better define that and say up to 100% buyout, up to 40% venture capital and growth equity. And as it stands right now on our separately managed accounts within emerging managers, it's a little over 35% venture capital. So we want that flexibility for them to be able to allocate even more.
Just as a point of information for myself, if you don't mind.
Oh, yeah, absolutely.
On that slide 33, so I'm understanding, where existing guidelines for buyouts, for example, 50 to 85%, that was the range given. And if I'm understanding this correctly, that 5% of the total fund value, if you see it prudent, you may use 100% of that 5% of the fund for that primary investment, if you see it, but also consolidating the ranges for the other two. Is that correct? So
yes.
Okay, thank you.
Yeah, Trustee, me.
Still the same slice, slide 33. Similar. It's very similar question like the one that I asked in earlier global equity, but this is in the context of private equity, assuming it might be slightly different. So imagine we have a very different investment team tomorrow, not this team. So they look at this approved guideline, right? Doesn't mean that they can go 100% to buyouts and buyouts only, and 100% to primaries and primaries only, right? So that does it defeat the purpose of diversification again? You know, that freedom, that removal of guardrail and structure, would that be a concern, right? Or yeah, so that's my question. I'd like to hear from both the team and also our consultant.
Yeah, Jose is here. Why don't we turn to the previous slide? So if we take a couple things. One, optically, our allocation of buyouts not changing as it stands here. We see 57% on the left-hand side, but on the right-hand side, we see 78%. So as it stands today, there's 78% exposure to buyout. And the way our buyout exposure increases or decreases is via funds or via co-investments and secondaries. Co-investments and secondaries have been a larger proportion of our allocation, has been a growing proportion of our allocation over the last 5 years, such that our buyout allocation continues to increase. And so if we were to, let's say, artificially put something that said 85% limit to buyouts, we may reach that through our co-investments and secondaries that are generating better returns than venture capital or growth equity. And so the risk return trade-offs that we make should allow us to, we are asking for you to allow us to make that risk return trade-off to increase our allocation whenever the markets sort of dictate that. The second thing to think about is that our venture portfolio has had great returns over time, but really it's the smaller managers that deliver greater returns. So if we think about making a commitment to a buyout manager that scales at $400 million of a potentially $2.5 billion budget, that is going to give us $100 or $200 million of co-investment relative to a $50 million venture capital investment, over time, we will end up putting more into the buyout portfolio. We don't forget that venture is important, but really the ranges here are not necessarily to have, very, very broad flexibility, but just enough flexibility. And also when you look at the ranges specifically, you don't see it sort of like getting crowded or up an upper bound. So if let's say we put 85% there, you'd say, well, you're only 6% away from your upper bound of the target. And our response could be, we have a slew of really interesting co-investments coming through that may get us close to it. Could we then increase?
Hold on, is it contributor? Because he came up for a response. I want to make sure you're not adding something else into the mix we're going to respond to. Do you have something to add on to that layer? Okay, I just want to make sure we didn't.
Yeah, I'll be quick.
Okay.
We agree with the recommendation, just the flexibility. We think given the risk reward trade-offs between buyouts and venture growth, it makes sense. It's highly unlikely that the program goes to 100% buyouts, but having that flexibility, and as mentioned, just getting close to it, because maybe the co-investment opportunities actually provide a better risk reward option at any given time than the growth and venture. That's why we believe that having up to 100% in buyouts makes sense.
And if I could just weigh in on this one, I know this is Stepstone's area to work with you all, but it does sort of tie back to asset allocation, which is where we weigh in and advise the board. So when we model private equity within the asset allocation, the things that we're looking at are the categories of buyout and venture/growth. We're not actually taking into account any other risk factor or return considerations by vehicle type. So this approach actually aligns better with the board approved strategic asset allocation by just using those two, I guess proteins is the analogy we're going with today. But so that aligns better with the SAA overall, in my opinion.
Thank you, Tim. Appreciate that.
Thank you, everyone.
Trustee Me, before we shift it over, did you get what you needed there and that? Okay.
Thank you.
I'm sorry, Trustee Ben.
Okay. This is also to help you too, Trustee Me, but also that SMAs and co-investments are something that not a lot of other people get access to, right? So the fact that we now have access to it and that we've proven that it works, it's other people can put money into venture funds, other people, other companies, other pension funds, but we're big enough where we're important enough that people want to let us come in for cheaper fees. That's giving more access to that. I'm down with.
Okay. Is there any other lot here before we? Okay, go ahead.
Okay, we have just a couple slides left. So if we could turn to the next steps. Here we have our initiatives, both completed, in progress, upcoming. And so I'll just highlight one from each. On the completed side, we finished a secondary sale of non-strategic private equity funds earlier this year that yielded over $1 billion. In process is our first private equity commitment to Southeast Asia and an India-focused strategy. And on an upcoming basis, we look forward to better looking through the portfolio for risk, our portfolio analytics and understanding risk better. With that, we turn to the recommendation side. And we ask that the board affirm growth as a primary driver of long-term returns, its implementation approach, and desired attributes. We also ask that the board approve the proposed portfolio investment guideline updates for both global equity and private equity. Thank you.
Thank you, staff. Any other question? Yeah, go ahead, Trustee Me.
Thank you, Chair. This is one last minor comment. If you can go to slide 47, it's an appendix. I want to highlight this slide to the whole board, as majority of us asked for more education in last meeting. This is a great piece of information set together, and thank you, that show us, how the process, internal process is like to making a deal, making an investment transaction, and how does it get to the board at the end, the last step as the delegate authority. So I just want to highlight, because in the appendix, maybe not everybody's noticed to that. So, and I thank you. I appreciate both slides 46 and 47 in the effort from the staff. And I have a tiny minor question on the slide 47. Comparing this process on both sides, right, the primaries and then co-investment and secondary, what I noticed is that consultant does not involve in the co-investment and secondaries. If you can share with the board the reason and why, and if we have the third party opinions and who are the third party would be great.
Yeah, a lot of research went into developing the program in 2018 and then launching the program in 2019, including the processes. Co-investments move much faster than fund investments. So we may get a call today with a 3 to 4 week timeline where we have to have our commitment completely finished, all our work finished that's on this timeline, and get an approval and finish our legals in order to receive a full allocation. As I mentioned earlier, co-investments and secondaries are highly competitive. So we designed the program to streamline our decision-making process internally. And as Chris may have mentioned in 2019, we had partial delegated authority for co-investments and secondaries. And then the second reason, and I say this kind of like tongue in cheek, is with Jose sitting over there, is Jose is our competitor to us when we look at co-investments and secondaries. It's a big part of their business. And so we want to keep ourselves separate there. We're highly collaborative. They're fantastic to work with, and they provide us a lot of insights and often serve as reference calls. But we really like to be able to capitalize on opportunities when our general partners share them with us.
And just for the benefit of the board, from a history standpoint, part of the move towards delegated authority and the steps that we took was a direct relationship to what Trustee Fay highlighted, that as we were growing, being able to leverage our size and relationships, there's a whole subset of opportunities that required a level of speed and effectiveness. And so part of our delegated authority transition was a function of how successful we were being going from mid-market, to a larger market. And I would anticipate, as we continue to grow here for the benefit of the new people, that as we get larger and other opportunities come to us, there will be more and more reliance on the sophistication of our staff that will far exceed even their ability to educate us on any one sitting period or not. So the delegated authority relationship is built on a high degree of trust based on prior performance and transparency and reporting, and more specifically, the ultimate accountability we have, not at the micro slide level decision-making level, but at the CIO level. So I just want to make sure that we, from our leverage where we think of ourselves as a board and where we're having accountability, it's not at the micro decision level, it's more at the CIO level.
And can I make one thought? And I hate giving people more work, but it could be really helpful. If at some point someone wanted to take a snippet of DDA's explanation and then make that a link to something, so for new board people that come on, they can watch that video with that slide and actually understand this. That means there's not going to have to be constant re-education.
Yeah.
Just a thought.
Yeah, it's on the website. It's public.
No, I mean just the specific like a 5-minute description of, hey, look, you're trying to find this out. Here's a library of things. Because as we get more educated, why not just keep on using the feature?
Yeah.
The way that we do private equity investing is not going to change. It might change, but we won't do less.
Right. My first official call for Trustee Langston. Trustee Langston.
Thank you. First, I wanted to thank you all so much for, as a new trustee, this was extremely helpful for me. I too appreciate the process being laid out. I really appreciate the acronym and glossary. That is just so helpful. And I completely understand and agree why we wouldn't want to be capped at 85%. So I appreciate the explanation and the detail that went into that. Thank you.
Any other questions at all before we go ahead, Trustee Green?
Real quick, but again, tagging on to what you said too, that with this change, this proposed change, the risk management process is still thorough and robust. You're still having the meetings to talk about these type of managers. You're bouncing off of our competitor or advisor, so to speak, and that think process is still happening. So that even with delegated authority, that risk management process is being seen through. That really, that delegated authority again is agility, it's speed all the points already made. So, it's
And
good.
just to take the pressure off the board a little bit too, particularly for some of our newer members, is that we're not expected to be CAIA, CFA compliant, you know what I mean, like experts. That's not our calling.
But we can play it on TV though.
Yeah, that's right. That's not our calling here. So I just want to make sure that we try and maintain the level of diligence about the area where we do have the most leverage, as Tim highlighted, which is the strategic asset allocation, the decisions we make at the structure review level, but not necessarily in the weeds.
I'd move to approve.
Actually, just to correct that, Government Code Section 315. I want to say 315.520.2, a lawyer can tell us, does require us, at least the appointed trustees, to have expertise in these matters.
That's not what I was told even.
Oh.
When I was appointed,
You
right?
can read
And I had
it.
a little bit of experience. Yeah, no,
You
I mean,
read
no. So that was what I was told. So we can clarify that, but just, we're not experts. We're not hired to be experts. We're trying to have some knowledge of it. And I'm just playing off the general pressures. I know we have a lot of new people here. I don't know, you probably maybe had more business or exposure coming into certain asset classes of investment. I've had some as well, but you still take the process where we're still relying on the trustworthiness and consistency and transparency of the experts and what we get in that process, and not necessarily burdening ourselves down or slowing our talent down by attempting to achieve the same level of sophisticated knowledge that we don't have, because we're not doing it every day, all day, every day. So in that balance. All right. So without there being any other questions there, do I have a motion to?
I move
Okay.
to adopt.
Second. Trustee Fang. Okay.
Okay. Mr. Green?
Aye.
Mr. Jackson. Okay, Mr. Jones?
Aye.
Ms. Ginsburg? Yes. Ms. Me?
I with the trust to the team.
Mr. Gatto?
No.
Mr. Fay?
Aye.
Ms. Langton? Aye. Okay, the motion passes with 1 no.
Okay. Thank you, team. All right, so let's do this 11 o'clock. Let's take a short 10-minute break, bio break, and then come back. And so they're all FYI. Are we going to be able to get? Oh, good. All right.
Anybody has anything pulled?
Do we have anything that needed to be pulled at all? Maybe we can just go straight in an executive session break. If they're good in the order. I'm sure there's something there. Okay, with that being said, then let's go ahead and transition to good of the order or items staff for review. Do we have any additional ones? Okay, items for future agendas. And then good of the order. Maybe the usual.
Oh, yes. Oh, I thought John was going to speak. I was
Okay.
watching. Clever. Ms. Langton? Yeah.
First, I want to thank everyone at LACERA who took the time to meet with me this past month and get me up to speed on all the essential information that I need to sit as a trustee on both the Board of Retirement and the Board of Investments. And I really want to thank Linda and Bonnie, who just are so organized and set everything up so beautifully. And then second, I want to congratulate out loud Esme Bosk, who was awarded one of the 100 Women in Finance award for the Americas and the 100 Women in.
Yeah.
Yeah. And if I may just, the 100 Women in Finance is a global leader in advancing gender equity and in finance, and annually celebrates exceptional women across the Americas, Asia, and Europe. And they award women who set the standard in leadership, ethics, and investment excellence. And our Esme got the prestigious Americas Award. So congratulations.
Yes, I know she stole your thunder.
Just
It's okay. It's all good.
add on to
It's all
that.
good.
No, I don't, it's not my thunder, it's Esme's thunder. Just
good.
one thing to add is there was a gala last week in New York City, over 500 people in the room. Esme stood to speak and delivered maybe the best speech I've ever heard. You know, it was the attention was rapt. You could hear a pin drop, and everyone afterwards was talking, you know, the rest of the evening about Esme and the speech. So I think that it was a highlight for me to have been there and to have the privilege of working with Esme.
Well, great. Well, I just want to make a pronouncement now that Santos, you're fully authorized, whatever retention bonus, now that she's out there popular and stuff we need to do, ball and chain to wrap her down. But no, congratulations. So great for you to get an award like that.
Miss B?
Miss B.
Congratulations. Yeah, well deserved. Thank you. And we'd love to hear that speech if it's recorded somewhere.
Yeah.
So as I said, I just want to say past Monday is Veterans Day. So I want to say, is anyone here serving the Army, thank you for your service. And anyone listening out there, thank you everyone for service to like make this a great country. You know, as an immigrant, myself, really grateful to be here as part of this country now. So thank you for your service, everyone out there. That's all.
Mr. Gatta? Okay, Ms. Ginsburg? Mr. Green?
It's a beautiful day out there. Glad to be here. And that's it.
Yeah, and
Any of the staff level? Okay.
Mr. Jones?
Oh, okay. So then just the final thing. This is 11th month of a 12-month tour of duty as chairman. As we attempt to land the plane on the year, I just want to thank everyone kind of in advance for what a great experience. I never knew when Keith Knox retired that the level of responsibility and engagement required on behalf of the chair. So I'm very excited about the impending passing of the baton, which I'm sure we'll be making the announcement at the next meeting as soon as when we kind of make that through there. But hand in hand with that goes to, you know, again, a lot of transition going on with the board in terms of new members, exciting challenging time as we attempt to connect old history with new energy and new point of view. Very proud of the team so far, $81 billion in assets. John and team, Santos, tremendous progress in terms of talent and hiring and things. Of course, Stephen Rice, a very key role for us in navigating us through the issue with our plan sponsor on that side. So just a lot of cool milestones this year that before December gets here and people and holidays and the rush and all that type of stuff, that I just wanted to kind of take a little bit of a pause just to kind of appreciate a lot of meaningful milestones that have taken place this year, driven in large measure by our leadership and by my colleagues here at the dais. So with that being said, let's go ahead and do a short pause. We'll have executive closed session just in case there are any questions on the items that we have there that need to be reported out. And then if not, we can adjourn early beyond that. Okay, so let's have 10 minutes to clear the room for executive session. Thank you.